In today's episode, I'm going to answer two questions. The first is, Ross, how do you adapt your strategy between a hot market and a cold market? Because no doubt, there are a number of changes I make in order to minimize my drawdown when it's cold and maximize my upside when it's hot. What I can tell you is that your ability to assess the current state of the market between sort of the spectrum of hot and cold will be critical to your long-term ability to really maximize on profits and minimize risk. I'm gonna walk you through the steps that I take to do that in today's episode. And the second question I'm gonna answer is the question, Ross, is it just me or does it feel like the market is getting harder? Do you think it's harder to trade because of AI and high-frequency trading algorithms than it used to be? Those are the two questions we're going to talk about today. And it's a rainy day, and I've got some errands to run, so you're going to come with me. Okay, so let's start with the first question. How do I adapt my strategy between a hot market and a cold market? So there's no doubt that I would love if it was always January of 2021, which for the record is when GameStop made its incredible run. But that's not the case. And if I was trading as if it were always January, February of 2021, I would do very poorly because that's not the current market we're in. So one of the things that I'll tell you is that over my years of trading, I have sort of come to recognize that, I don't know, maybe 90% of trading is sitting and waiting and being patient. And the remaining 10% is actually being in a trade. It may even be skewed more towards waiting. So your ability to be patient is very important. And there are periods when the market is cold and it's slow and it feels like, you know, we'll have a couple of moves, but it's just not a lot. And the difference between trading in that market versus trading in a hot market where we're seeing back-to-back 50%, 75%, 100% moves, or trading in a market like GameStop where everything's going 1,000%, it is like almost literally the difference between night and day. And so I know from my own experience that when we're in a cold market, sometimes I'll ask myself if I even know what the heck I'm doing, because I get sort of like almost just taken aback by the fact that everything I'm kind of looking at and what I'm expecting doesn't resolve the way it normally would, normal being in a hotter market. So this is what I do. And to give you some context, the period of like 2017, 2018, 2019, those were good years for me. That's when I began my small account challenge. I funded it with $583.15. And in 2017, I was up $335,000 versus that initial starting balance of less than 600 bucks, which is crazy. And I'll say right now, my results are not typical. Trading is risky, and there's no guarantee you'll make money as a trader, whether you learn from me or trade on your own. So do please manage your risk. 2018, the market was pretty hot. Cryptocurrency was strong. Bitcoin was you know, at the beginning of its big move, and I ended up making $500,000. 2019, cryptocurrency and Bitcoin had crashed, and we were sort of in the like the dark side of the moon. It was getting a little cold out there, and I think everyone was a little nervous. And I made, I think, around $360,000. A little bit of a slower year. And then we came into 2020, and initially when we had the 30% market drop in March, I wasn't up a whole lot on the year, and I was like, this is going to be really bad. And then in April, I had the best month of my career, and in May of 2020, I made over $1 million, which was insane in 1 month. Because what was happening was we were seeing back-to-back 1,000% moves. It was unreal, unlike anything I'd ever seen. And I think the cause of it was the stimulus, all the money that was pumped into the economy. The Fed printing machines were on, and they were just printing money, and people were buying the market, and it was a really incredible time. So I was able to recognize pretty quickly that the market was hot. I mean, every day I was sitting down and we were having 100, 200% gappers, and they were continuing to push higher and higher and higher. So it really only takes a few days in a row of seeing that, most likely for any reasonable trader, to realize it's time to like lean in and put the pedal to the metal. So the shift from cold to hot can happen very quickly, and that is what happened in 2020. It was very, very cold in March, and then all of a sudden in April, we started seeing like back-to-back serious moves. And then I started thinking, okay, the next one that I see that pops up, I'm gonna jump in with even bigger size, right? I'm gonna be even more aggressive. That's the common sense thing to do. That's leaning in when the market's hot. So I increased my share size. The profits that I was making, I did not take out of my account. So my account started getting bigger and bigger and bigger each day, which meant each day I could buy a few more shares, right? My account was growing. And because it was growing so quickly, I was sort of just letting it roll so I could really maximize on what I was seeing as an incredible opportunity. Now, during that time, the changes that I made to my strategy, in terms of position size, I made the change of increasing position sizes, taking more risk. Okay, that makes sense. But what I changed in my strategy was that I was buying a lot faster. I wasn't waiting as long for a setup to prove itself. If I saw something starting to pull away, I was buying at the first half dollar or whole dollar it was approaching with like a 25-cent stop. Because I just kind of knew and recognized that in that market, traders weren't waiting, they were jumping. It was like jump first, ask questions later. And so I jumped on that bandwagon and I was doing the same thing. And this is true of any hot streak. Any hot streak is similar to this. This was just sort of the most extreme. And so during that period, I was being very aggressive. I was jumping in faster. Even a setup that I may not have been as likely to trade during a colder market, I was willing to go ahead and buy during the hot market. So my quality threshold sort of drops a little bit. You know, it's just kind of like when it's really hot, even a sort of B or C quality setup can still end up working out really nicely. So in a sense, I kind of loosened my filters. I increased my share size, I reduced my quality standard a little bit, and I'll kind of keep doing that in order to cast a wider net and try to catch as many trades as I can. And when the market is hot, I'm gonna catch a lot of trades. And so my frequency of trading increases, the total number of trades I'm taking increase, the amount of time I'm spending in front of the computer each day will increase. Instead of walking away at maybe 9:30 or 10 on a day in a cold market, I'm staying till 10:30, 11, 11:30, 12, 12:30, 1, 2. Maybe even I'm staying all the way till 4 p.m. And then maybe at 4 p.m., the market's been so hot that I'm watching to see if there's gonna be any headlines at the close, like earnings or something. And then maybe there are, and next thing you know, we've got a stock squeezing up 400, 500% after hours. And there were days during the hot market where I would sit down, and I'm not kidding, at 3:45 in the morning so I could start trading at 4 a.m. And I didn't stop until 8 p.m. That's pretty intense. Now, I didn't do that every single day, but when it was really, really hot, I was burning the midnight oil because it made sense to. The market was that hot. Okay, but all good things come to an end. And so how do you recognize the shift between hot and cold? This is easiest to see, honestly, in your own P&L, because what's gonna happen usually towards the end of the hot streak is you're gonna have a couple of close calls. A close call could be, you buy one of these stocks and it totally dumps on you, but then it comes back up to break even and you get out break even, you're like, whoa, that was close, because with big size I almost just got totally smoked. Or you have a day where you do go pretty deep red, but there's a number of opportunities and you are able to kind of make your way back out of the hole and perhaps even finish the day in the green, but just barely. So these are kind of like those early tremors that there's a big volcano or whatever coming, like things are starting to shift a little bit. And then usually what happens is you'll have a red day. And it's often a pretty big red day because you've loosened your filters and expanded your risk tolerance. So then you get hit, right? You get a good hit, a big red day. And because the market's been hot, you come back on day two thinking, it's all good. I'm gonna be back at day two. I'm gonna make back what I just lost, no problem. And next thing you know, you're on 2 red days, and it's like everything is rejecting. What's happened is sentiment has shifted. Traders are feeling a little more cautious. The buyers are sitting back, and the bears they smell that weakness. Sharks, they smell the blood in the water. They're starting to get a little more aggressive to the short side. So you have that shift. And that can be just sort of a momentary shift that immediately kind of goes correction back to a strong bullish sentiment. If you have a stock that has like really good news, it just goes crazy, or when the markets are at the all-time highs. But when the shift happens and there's other uncertainties out there, like there are right now, with interest rates and, you know, people talking about recession potential and all that, that's when you're more likely to see a more sustained shift to the short side and sort of a colder market. Now, one thing that I can say about being a long bias trader is that you look at any 10-year, 20-year history in the stock market, it goes up, right? So being a long bias trader in a market that is pretty much designed to go up and always has gone up makes a lot of sense. Being a short bias trader in a market that's always going up is harder. Not to say it can't be done, but it is harder. But for me, when the market does start to cool off and I have a couple of these red days, I need to make some adjustments. All right, so what adjustments do I make for a cold market? If I have just had 2 red days, this is when typically I'll check myself into trader rehab. I lock it down. I'm like, all right, that's it. We had a good time, but now it's time to get disciplined, get focused. Trader rehab for me means I'm bringing my share size way back down. I'm going to cap myself at a pretty minimal share size until I've recentered and recovered emotionally from the loss. The financial recovery might take more time, but the emotional recovery of rebuilding confidence, it usually will take at least a week if the loss was big. So I reduce my share size, scale way back down, and I bump up my quality standards. So now I'm back to saying, look, if this thing isn't a quality based on my criteria, the price being 2 to 20, the float being under 20 million shares, preferably under 10, relative volume being at least 5 times higher, it being up at least 10% today and having a true catalyst, then I'm not even going to touch it, right? So I start getting really dialed in with these restrictions, and this gets me back to focusing on A quality setups, which then improves my accuracy, improves my profit loss ratio, and I kind of get back to the recovery. All of this is basically what happened to me, just in a nutshell, in a sense, in 2021 through 2022, but even just in February of March of this year. February was up $130,000. The market was incredible. It was super hot. It was quite ridiculous, in fact. I loved it. And then in March, I was up 30 grand, and then in 2 days, I gave it all back. I went to flat on the month. I actually went to, I think, slightly red. And so when that happened, I checked myself into trader rehab, brought the share size down, put a cap of 5,000 shares on my account, and I said, I'm not gonna take the limits off until I recover. But it took some time. It really did. And so I ended up, kind of being in this drawdown. And as it turned out, that those 2 red days that I had where I lost 30 grand, that was like the transition into a cold market. And now for the last six weeks, the market has been colder. But over the last 6 weeks, I have been consistently making money. My account has been growing. So how does that work? Because I adjusted my share size, because I put these risk parameters back in my account, I increased my quality standard, I'm trading less, but I am making money. I'm not taking the high risk trades that resulted in the big losses. I'm not getting the home runs that can sometimes come when you take higher risk, but I'm locking up base hits consistently. And so what this looks like sort of on a big picture is periods of time where I've got these big green spikes. The equity curve is skyrocketing. I'm making a ton of money. And then you have a couple of, usually like a red week or something like that. And then I go into a period of a lot of small green days. Now, my equity curve still goes up. It recoups the loss and it's going up, but small green days. One of the techniques I've been using that's been really helpful for me in this period of recovery has been telling myself, I'm going to keep it capped at 5,000 shares and I'm not going to increase my share size until I'm up more than $1,000 on the day. Once I'm up more than $1,000, then I take my cap off, I size up. And what this has done is on the days where I've been red, I've only been trading with a max of 5,000 shares, which is about a quarter of my full size position. So I'm keeping my risk very minimal. I'm not going down that far. And then on days when it's hot, I'm sizing up fairly quickly. And next thing you know, I'm hitting my daily goal of $5,000. But it's like I wasn't really risking going red more than, maybe $1,500, $2,000 on the day, which is really great. Now, in a hot market, I'm not going to want to waste my first 2 or 3 trades trading with small size. I'm going to want to be aggressive pretty much on trade number 1, and I'm going to get paid for doing it. It's going to be riskier, but I'm going to be in a market where it would almost be foolish not to. And that, again, requires you to make a really honest assessment of the strength of the current market. Is this the market I should be aggressive, or is this the market I should be slow? So you've got to trade the market you're in, not the market you want to be in. These are really sort of, this is the biggest concept here. Now, I will say in my trading that there are some other adjustments that I'll make. During the colder market, I'm more reliant on certain indicators like MACD, moving average convergence divergence indicator. I like this indicator specifically because it helps me focus on trading just the front side of the move, and it reminds me to leave the back side alone. And then I'm also more cautious on trading stocks that are more expensive. So just generally trading a stock that's, $25, $35, $40 a share, I might just leave that alone completely in a colder market. So I'm going to kind of just, again, narrow down to what I'm kind of best at, add a couple more checks for kind of quality control. And then from there, I try to keep my head down until we start to see a couple of days where all of a sudden in my first, 30 minutes, I hit the $5,000 daily goal. And then by the end of the morning, I'm up, 12,000, and I'm thinking maybe I should keep trading today. Like maybe I'm going to go to 11 or 12 or 1. And then I start having 3 or 4 days in a row like that. And now it's like the expansion period's happening, sentiment is shifting, and it's time to lean in. Okay. So if that makes sense, or doesn't, or you have questions, please throw them down below in the comments. So now the second question, Ross, is it just me, or is it getting harder to trade? So the question was, from a seasoned trader with years and years of over a decade of experience, how has the market changed? And what I can tell you is that in my perspective, I don't feel like it's getting harder. There are some things that have changed that I've noticed are different that we didn't used to have. Some of them are a bit of an issue, and I'll talk about those in a moment. But overall, in total, I would say that it's getting easier because I have more experience. From when I started trading up through, like basically to the pandemic, I kind of would separate my trading into maybe 3 or 4 sort of periods. I had the trading before I began my small account challenge. I had my small account challenge until COVID. Then I had the COVID pandemic window. And then I had like sort of the post-pandemic period now. My first window of trading, we were still dealing with quantitative easing from the Federal Reserve, the stimulus program that they had brought into effect after the Great Recession. So we were in a period where even though the market overall was pretty strong, trading was difficult. And it honestly felt like most days were cold and there wasn't anything. But periodically there'd be something huge. And you would get so much FOMO and regret if you missed that move, because it was like, oh my gosh, that was the one, like, it was almost like being a hunter and finally a big moose goes by and you snooze through it and you totally miss the opportunity. And that's kind of what it was like in that period. You had these brief windows, and if you missed it, it just made a huge dent on, in a negative way on where you should have been out in the year. So a lot of my profit was coming from just a couple of really good months when it was hot and the rest of the year was cold. And so it wasn't uncommon to have periods that were like 6 months long where I would make progress, but just not a lot. I might only be averaging like $4,000 or $5,000 a month. And then I would have a $30,000 month, just boom. So it's like I had to just keep showing up every single day because you never knew when it was going to start to pull away. And then 2017, 2018, I think the surge in cryptocurrency brought a lot of traders in the market, brought a lot of wealth into the market, and maybe more speculation. So things did start to pick up 2017, 2018, and 2019. But again, 2019 is when things started to cool a little bit. And then we went into the pandemic when things were insane. During the pandemic, things got easier because everything was moving big time. I mean, it was really intense. And right now is harder than the pandemic, relatively speaking, but I feel like it's easier than the pre-pandemic time. Maybe that's because I've got a lot more experience under my belt and I just have more confidence. That's a possible factor. My green days now are still bigger than the green days and the green months prior to the pandemic. So I think some of that is just the biggest thing that you have control over is continuing to gain experience. The market will change, but you adapt with it. So, and you adapt naturally because you're just going where the money is. So I started trading earlier and earlier. Before the pandemic, I never started trading, basically never, before 9:30 a.m. And then during the pandemic and now currently, I'll start trading at 7. And when it was really hot, I would even start trading at 4. If we switch to a 24-hour market, I'm not going to trade in the middle of the night, but we're going to see more volume at different times because people from all parts of the world are going to come to participate in the US market. So I think that we will see just more volatility basically right when we have breaking news, which makes sense. So this period right now, the thing that I've noticed more of are the jackknife moves, where we have this consolidation and then we end up having a pop and then a huge rejection, a huge flush. And I sort of thought that that was like one just really aggressive market maker or hedge fund or I felt like it was kind of like one trader. And I sort of got the feeling that that one trader got smoked earlier this year on one of these 1,000% moves, because after that, it was gone for a while. We didn't really see it at all. And now we've started to see it come back a little bit in a couple places, but still not to the extent that we had it before. So I don't know. I'm not sure what that was about exactly, but that was something that did make me a little more cautious buying breakouts. But I still felt comfortable buying dips. And when we would get the jackknife reversal, I would often buy the bottom of that candle for the bounce back up. I think as you gain more experience, you'll get better at looking at your metrics and being able to make those assessments of, what's different in this last month and in the previous month, and where am I doing well and where am I struggling? And then you lean in where things are working and you kind of pull away from things that aren't working as well. So for me, I noticed in the month of March that I wasn't doing as well in higher price stocks. So then in April, I said, I'm not going to trade anything above $20. And that ended up being a good decision. And ultimately, I really didn't see that I was missing a lot. Now, if I would start seeing big moves in that price range, I'll dip my toe back in the water. But I'm just going to continue to be in that process of looking at my metrics and making adjustments based on what my metrics are telling me, because that's a reflection, obviously, of how well I'm doing, what's working, and what's not working. Now, to answer the question more directly about AI and high-frequency trading algorithms, high-frequency trading algorithms are nothing new. They've been around for decades. And so for my entire career, I've always, since I kind of realized this, I stayed away from stocks like Apple, or trying to trade the S&P 500 or something like that, because I just recognize that so much of that price action is dominated by high frequency trading algorithms. In my episode on Bookmap, I showed this really incredible view of the IWM, and the Bookmap shows you all of the historical level 2 on your chart, so you could see where orders were placed and canceled. And it's like it's like crazy, because they're just placing cancel, place cancel, place cancel, place cancel orders. It's just flashing, it's flickering. And those are these algorithms, and they're really, you don't want to try to trade against them, because if you're trying to trade against them, it's like playing chess against a computer. You will lose. And I said that when I wrote my book, my first version of How to Day Trade in 2015. I said that exact same analogy. Trading those types of stocks is like playing chess against a computer. You will always lose. You need to know where your edge is. And my edge is trading a stock that has breaking news with high relative volume, with a lower float, because those are the stocks that make those quick moves. And when you get that 50, 75, 100% move in 15 minutes, that just doesn't seem to be where we're seeing high frequency trading algorithms or market makers flooding the market with these weird orders and doing kind of this manipulative stuff. We just don't see it. All of a sudden, we just see a stock that has news and squeezes up, and we get clean price action. So for me, part of being patient is waiting for these windows where I think the price action will be clear and clean. And if we don't have it, then the best thing for me to do really is sit on my hands, be patient, and wait for something else. So this comes back to really the concept of discipline. If you can be a disciplined trader, that's going to bode really well for your success in the future. And that means discipline and being able to understand hot market, cold market, trading the market you're in, knowing when to ease off the throttle, knowing when to be aggressive. Patience in sitting with a drawdown if you're in the red, knowing that you'll make it back, but it's going to take some time. I'm going to have to sit with it for a little while. Patience with waiting for those A-quality setups. So if you found this episode interesting, you found it helpful, I hope you hit that thumbs up. I hope you subscribe to the channel and throw some ideas down in the comments of things that you would like me to address in upcoming episodes just like this. Thanks as always for tuning in. Reminder as always, trading is risky. My results aren't typical, so manage your risk, take it slow. I'll see you back here for the next episode real soon.